Welcome, everybody. Thank you for joining us. My name is Paja. I'm the new business team as well as the marketing team for today. So we're very excited about today's webinar. This session, it's all about helping agents better understand what are the more innovative concepts entering the fixed index annuity space and how it can create a stronger client conversations around growth potential and retirement accumulation. So we'll walk through exactly what the SmartBoost Index is and what that 40% boost actually means, how it impacts contract values, and where this product may fit for clients looking for protection with growth opportunity. We'll also review a hypothetical client example so you can see how the strategy works in a real world scenario and identify potential sales opportunities you can apply in your own practices. So, joining us today are two industry experts with deep experience in product development, annuity strategy, and agent support. So, first we have Jeff Barnes, who's the Regional Vice President at EquiTrust. Jeff has more than 30 years of industry experience and he works closely with marketing organizations like us and agents to support growth, product education, and sales strategy. He's also been heavily involved with the NAFA leadership and education innovatives throughout his career. We're also joined by Chad Onstadt. He's the principal actuary at Genesis. Chad brings more than 15 years of annuity product and development and consulting experience and plays a key role in the development and marketing of innovative retirement products. So, with these two, we appreciate you both being here today and sharing your expertise with us. So, we can go ahead and jump right into your presentation.
That is great. Thank you, Paja. Thank you so much for having us on the call. Very excited to be able to share SmartBoost with you in pretty deep dive into it. I think it'll be a great meeting, and we're very excited over here at EquiTrust to boost in our product portfolio. It has been making the phones ring. It is a very unique product. No other product out there like this. So we're very excited to have Chad on the call with us. And Chad is with Genesis. And Genesis, they've been around for a while. Genesis was, pioneered the very first fixed indexed annuity in the United States in 1995. They've got over $50 billion in products sold through carrier partners. And then they've got over 17 patents in development, innovative retirement solutions. So, Chad, thank you so much for joining us today.
Yeah. Thanks, Jeff, and thanks for NFI for having us on. We're really excited to talk about this new product. We're really excited about the partnership with EquiTrust. You guys have been around for a long time and done a lot of great things with product. Just a great carrier to work with, and so we're very excited to talk to you guys about this today. Just a couple other data points about Genesis. So as Jeff mentioned, we've been around a long time. Our claim to fame is that we pioneered the first indexed annuity in the United States back in 1995. We've prided ourselves at being on the forefront of innovation in the FIA space since then. We've come out with a number of different things, the multi-year point-to-point. We actually have a patent related to GLWB riders on an FIA. So we've tried to stay at the forefront of innovation, and that's what we've done here, we believe as well. We're a bunch of product actuaries at Genesis. I like to think about us as product nerds. We sit around all day and think about ways to innovate and improve on what's out in the market. And what we set our sights on recently was improving premium bonus products. And so when we look at premium bonus products, we know they're very popular. So over 30% of all FIAs sold last year included a premium bonus on the accumulation value itself. There's another 10 to 15% that would include a premium bonus on a value such as your income base. But we're not talking about that type of product here today. We're focused on accumulation. And so there are a couple of key places where premium bonuses are being used primarily. The first is through the exchange business. And so we have a lot of clients that were issued policies in a low rate environment. So they had pretty uncompetitive rates. And we see premium bonuses being used to offset those existing surrender charges and get the client into a current product with much higher rates. So that's been very prevalent the last few years. I think it'll continue to be prevalent for the next few years at least as well. And then the second place is for Roth conversions. So you might have clients out there worried about rising taxes and they want to lock in their tax rate today. And so a premium bonus product can be positioned to help offset that tax on conversion and get the client into an FIA, so downside protection with upside potential. And so these are great use cases for a premium bonus product. However, what's the downside of the current premium bonus market? What is the cost of the bonus? And as I'm sure you guys are aware on the call, the cost of the bonus is that your crediting rates are often materially lower with the bonus than the non-bonus product. So we're just throwing up a few different examples on the screen. This isn't meant to call out any specific carrier because this works the same for every carrier in terms of how the math works with the premium bonus. But if you look at, let's say Allianz, for example, they have a premium bonus product with a 5% cap and a non-bonus product with 8%. So if I'm only getting a 14, 15% bonus and I'm giving up potentially 3% a year over a 10-year period, which all these products are, more often than not, the non-bonus version is going to win out in terms of accumulation potential. And some of the other carriers on this list, such as American Equity and Aspida, have even larger gaps between the bonus and non-bonus version. So often, these may be positioned to clients as free money, but the reality is it's not free money, right? We're taking that money from the option budget, from the crediting rates, the cap and par rates, in order to provide that upfront money. And so what Genesis thought is, ultimately, we really worry about what that accumulation potential is going to be for the client over the life of the product, which is 10 years. And so if we're giving the client less accumulation, is there a better way? Is there a better way to provide the benefits of a premium bonus without the hit to the accumulation potential? And that's exactly what we did and what we set out to do with SmartBoost. And so this is going to be the industry's first product with a premium boost, not a premium bonus. Why? Because it works differently. The math is different, and therefore the benefits we can offer and the upside potential are quite different as well relative to a premium bonus. And so let's go get into how this is different. So what is it? It's a 40% boost with no fee. And as I mentioned, it's a boost, not a bonus. And this is going to optimize bonus and non-bonus product features into one. And it's the first of its kind in the FIA landscape. So what exactly do I get from this 40% boost? Well, the first thing you're going to love is that this is top tier guaranteed accumulation. The 40% boost at its core is a 40% guarantee return over the 10-year period of the product. And that vests at 4% annually. Okay, 4% simple interest every year annually guaranteed inside the FIA. So Jeff, when we talk to a lot of advisors, they're leading with this story, right? Really talking about this strong guaranteed growth, 4% annually, right? There's no other FIA offering that with the upside potential you're going to get in this as well. And so that's the second piece, is that because of how we design the product, and we're going to get into details about that, because of how we design the boost and the fact it doesn't work exactly like a premium bonus, we're able to offer much higher cap and par rates for your client, competitive with non-bonus products. More competitive, I would say, than the market non-bonus product in a lot of cases, but you'll see that coming up, and we're going to show you how this product compares to some of the top premium bonus products in the market from an accumulation potential, and you'll see the power of the boost. And then finally, just like a premium bonus product, the boost is an immediate legacy benefit. So day one, your client has 140% of premium death benefit for their beneficiaries, and that's paid out over a 5-year period. So this is what the boost provides. Now, why is this better than a premium bonus? And in our opinion, we're going to talk about that. What are the advantages over a premium bonus for a boost? So two of the advantages you're going to hear me say over and over: higher guarantees and higher accumulation potential. That's the true story. What do I mean by higher guarantees? So if you look at a typical premium bonus product and you're saying it doesn't have a fee, often those are going to come in about a 10 to 16% range. And so that means you have a 10 to 16% guaranteed return over the surrender charge period. Well, now that's 40 with our 40% boost. You may see some premium bonus products out there that are in the 20 to 25% range. Those often come with a 95 basis point fee. So when you look at the guarantee, ultimately it gets back in that 10 to 15% range. So we're starting off with much higher guarantees than a premium bonus, and that's advantage number one. Advantage number two is the higher accumulation potential. And we're going to show you head to head how this competes with some of the top selling premium bonuses in the market on accumulation. And just as a preview, it wins in 100% of the historical scenarios analyzed. Okay. The other part, and this is really a side benefit, but it's a core feature when we were working with EquiTrust in this product, is that this is all coming with a clean accumulation engine through the S&P 500. We're not coming to you and saying, hey, we got some guy and he built this index and he's smarter than S&P 500 and it's going to outperform S&P 500 in the future. Okay, that doesn't work. We saw that fail the last few years, on several custom indices. This is all clean accumulation, no custom index stuff based on the S&P 500, and that's the lens we're looking at for our competitiveness. And then the third is that strong death benefit. So there's no premium bonus product out there offering 140% of premium on day one. And so this is also stepping up your legacy benefit relative to those other products. And when you package this all together, we're going to talk about a really cool use case. And that is that SmartBoost is going to be the most effective Roth IRA conversion solution you can find in the FIA space. And the reason I say that is because the 40% boost can offset even the highest federal income tax bracket of 37%. So Jeff, as I mentioned earlier, and we're going to go through this in detail later, you have advisors out there positioning current bonus products would say a 10 to 15% bonus for Roth conversions. But for most clients, I would say the tax rates are typically 24% or higher. So they're not offsetting all the tax, whereas with the boost, we can offset all that tax because it's 40%. And so you may ask yourself, well, how can we do all these things, right? How can we beat the premium bonus product in these various different categories? And it comes through a smarter design with our smarter crediting. And so when we looked at non-bonus products and we said, why do they outperform bonus products typically on accumulation? Well, it's because when you get an index credit, let's say you have 100,000 premium, if I get a 5% index credit, I add that 5% to my initial premium. Okay, so my account value becomes 105,000. Now, if I look at that for a bonus product, let's say they had a 20% premium bonus. Well, that 5% credit is now going to cost 6,000 for the carrier, right? Because I get 5% of 120,000. And so that obviously means I can give you lower cap, lower par rates because I can't afford the same dollar amount in those situations. So we have to cut the cap, we have to cut the par rate to pay for that premium bonus. And ultimately that lowers your accumulation potential in the long run. So what we thought was, why not follow the non-bonus design when we apply index credits? And what's that mean? That means we're only going to add index credits on top of the premium in SmartBoost as opposed to the premium plus the boost. Said differently, the boost itself does not earn interest. And that may sound like a bad thing on the surface, Jeff, but if you stay with us for just a couple more slides, we're going to show you how powerful that is in terms of your upside potential, and it's going to allow for much higher par and cap rates. It's a benefit, right, as opposed to a negative feature, and you'll see that. So let's do that. Let's go and compare SmartBoost to some of the top selling premium bonuses in the market head to head with the same crediting strategies. So we're going to start off with a 1-year S&P 500 participation rate strategy. And we're looking at a few of the carriers that offer that in the market: American Equity, Aspida, North American. There's several carriers where you can't actually get a 1-year S&P par. They're only going to give you a 1-year vol control par or a 1-year S&P cap. They don't even allow you access to this. But taking a look at this list, you can see right away, if we look at that far right column, and I'll pull up my pointer so we can take a look at it. On these premium bonus products, and they're ranging, 14% is the no fee version. They have 21% with a fee. They're offering you 1-year S&P par rates between 15 and 23%. Versus SmartBoost, where we have a 50% par rate. So can you see how much more accumulation potential we're going to have with double or even triple the par rate over time? That's where that smarter crediting comes in. That's where SmartBoost is going to win on that upside accumulation potential. So let's put some numbers to this. So the way that we do backcasting and what we're going to show you, we go back 50 years on the S&P 500 all the way back to 1975. We act like we issued a policy on January 1st, 1975, issued another one on January 2nd, 1975, so on and so forth. We hold all those policies for 10 years. Why? It's a 10-year product. And we look at every possible 10-year scenario we could have had over the last 50 years. That produces over 10,000 data points for us to look at and compare these products against each other. And so first, we're going to show you how the guarantee compares. So we already talked earlier about how it has a much higher guarantee. So for SmartBoost, 100,000 premium, you're guaranteed 140,000 at the end of 10 years. 40% boost is a 40% guarantee. Whereas for these other products, you're ending at 114,000 or even less for the fee versions. Remember, fee erodes your guarantee actually over time. Now, on average, so again, what the average means is we look at all 10,000 of those 10-year scenarios, what the ending value was at the end of 10 years, and we average them across all 10,000 of those scenarios. So for SmartBoost, we ended at roughly 185,000. The next best was Aspida at roughly 150,000. Okay, so there's no one coming close to the average accumulation that we have on this page. So we've got way more guarantee and we've got way more average. And when we show you the best case scenario, so this is the best out of those 10,000 scenarios, we really jump off the page because we've got double to triple the par rate as some of these other products that you're seeing. And so we ended up at 247,000 in our best case scenario, where Aspida was still less than 180. And the really cool part is no matter which 10-year scenario we went through, the last decade, every good scenario, every bad scenario, SmartBoost won in every single one. And that's due to the combination of that high guarantee. So in those bad scenarios, like the last decade, we were winning, right? And our much higher par rate of 50%. So we were winning in those best cases as well. And just to throw a few more carriers on the list, we also want to show this for an S&P based index with a volatility control. We do have one that we like pretty well on SmartBoost. It's called the S&P Dynamic Intraday Index. This is not a custom proprietary index. This is an S&P based index with a volatility overlay. And you may ask, why do we have a volatility overlay index? It's really simple. If I do not have a volatility control or target, then if the markets get volatile, my crediting factors may change. They may have to be reduced, right? Markets gets really volatile, option costs increase. I may have to lower my par rate. What the volatility target does for you is maintain stable option prices so that EquiTrust can have stable par rates and your client can have stable par rates. So if you like stable par rates, volatility targeting is what gives you that. If you're okay with par rates or cap rates moving around a little bit, then non-volatility control is where that's at, okay? So that's the only purpose. This is the only one we have. It's just S&P and cash with a volatility control, again, to maintain stable rates. We're not going to talk about the par rate differences because another point, and I don't think this is very well explained, Jeff, by a lot of folks, certainly when these were launched, is that many of these indices only have a 5% volatility target. The S&P on average has a 15% historical volatility. Okay, that doesn't mean every year, that means on average. So if I have 5% volatility target, I'm only capturing a third of the index return on average. Whereas a 15% volatility target will capture 100% on average. So when you look down here and say, well, this is 85 par, 85 is greater than 70. Well, no, you need to multiply 85 by 33% and then compare it to 70. Okay, that's how the math works. So I don't get enamored by these high par rates, these 100, 200%. What really matters is how much index return you're getting, how that turns into product return and account values. And so that's what we're going to focus on for the next slide. So all of these are products with S&P based volatility targets on them. So Athene, for example, that's the only way you can get an S&P par rate. Allianz, similar to that. Guarantee story is the same as before, 140 versus roughly 114 or 116 depending on the bonus. On average, we ended at roughly 267,000. The next best on this list is Athene with their S&P Fast Convergence Index at about 225. So again, we couldn't compare apples to apples because they don't offer pure S&P par, but we're going to do orange versus orange with S&P based volatility control, and we still win on that basis. In the best case, it really jumps off the page, almost up to 350,000 on a 100K premium for SmartBoost. The next best is roughly 270,000 for Athene. Now, we can only go back 20 years for these indices because they don't have 50 years of history. Normally, they only have 20. But looking at the last 20 years, we had 2,500 different data points. And again, SmartBoost won in 100% of those cases. So when we stand here and say our objective was to give you the benefits of a premium bonus without the hit to accumulation, that's exactly what we delivered, right? And more. We increased your guarantee. We increased your upside. We increased your legacy benefit, right? And the data proves that with historical analysis.
And Chad, I'll jump in just really quick. All of this with no fee.
Yes.
I mean, that's what really blew me away when I first saw SmartBoost was that, we're taking it's a fixed index annuity. It's a safe sleep at night product, and we're making it more, it's a sleep at night product with that guarantee. You got the upside potential and all of that. It's priced in there. There's no external fee.
Right. That's right. I mean, we've heard advisors refer to it as the no apology FIA, right? Because no matter what happens, I'm going to get that 4% return, and I've got this upside. So you no longer have to apologize for zeros. All these custom index stuff that's out in the market that hasn't worked well, right? There's a lot of advisors that had to apologize for that. You no longer have to do that with this product. And just for completeness, I want to show you the S&P cap. Before I get into this, I think it's really important to understand Genesis does not like comparing S&P cap products in the market, and here's why. There's a massive cap subsidy problem going on. EquiTrust isn't playing the game, and we really appreciate that. They're not playing the subsidy game, but there are a lot of carriers out there that are. And what's that mean? That means that they're spending more, their option budget, they're spending more on the cap than on any other strategy in their product. Why are they doing that? They're doing that because what advisors, marketers typically look at is the cap rate as a first benchmark on the product. And so insurance carriers have been encouraged, if you will, or incentivized to subsidize their cap rate to make their product look more competitive than it is in practice. So because there's all these subsidies going on in the cap, it makes it really difficult to compare a product apples to apples. And the problem with the subsidy is that it can be here today, gone tomorrow. If I subsidize that initial rate, there's a high likelihood it's going to get cut in the future. It may just be a teaser rate. And so, there are a few carriers that are doing it more than others on here. But the reality is that the math is the same, Jeff. Our cap rate should beat the cap rate of any bonus product over time because we've got a more efficient algorithm. But you'll see on the next slide that some of these products keep up with SmartBoost, and it's due to that subsidy in the cap, unfortunately. So SmartBoost beats every product on a guarantee still, on the best case basis. On the average, there's one product that keeps up with us, and that's North American. And again, I would just say, go look at their cap rate versus all the other crediting rates, and you're going to see that there's a much higher option spend on that than the other ones. Whereas if you go to SmartBoost and you look at the option spend, doesn't matter what crediting strategy you're looking at, fixed rate, cap rate, par rate, S&P dynamic, the option spend is about the same for all of them. So they're not playing the subsidy game. What's that mean for you? That means that you're going to have more stable renewal rate experience with EquiTrust likely than you're going to have with some of these other carriers that are playing the subsidy game. Okay, so we feel very strongly about that. We don't like this teaser rate stuff that's going on. Okay. Product mechanics. So some of you may already be familiar, but we want to go through this for those that are not. And so we're going to start off with what the guaranteed illustration looks like, and we're going to walk through some of the values. And so the first value you should be aware of on this product is what we call the EAV. It's called the Enhanced Account Value, Accumulation Value. This is your premium plus boost. This is the value that is payable on death over a 5-year period if you select that option. Okay. Our account value, this is your initial premium plus interest credits, okay, in the first 10 years. At the end of 10 years, no matter what happens with the market, you're guaranteed at least $140,000. So you're trued up to that 140 because we said it's got a 40% guarantee. But you don't have to wait 10 years to get access to the money. The 4% guarantee is going to vest. We call this our vested guaranteed enhanced value. It's a really long name. I refer to it as the vested guarantee. Okay, our vested guarantee starts at your premium and it increases $4,000 a year, 4% simple interest, up to 140. Now, if you don't want to take the client or beneficiaries rather don't want to take a 5-pay death benefit over 5 or a 60-pay death benefit over 5 years, they can instead decide to take what's called our vested enhanced accumulation value. That's the greater of your premium plus index credits or your premium growing at 4% simple interest. So there is a lump sum option on death and it's this value, okay? Or you can have this value over a 5-year period. This is also going to be the value that we use to determine your surrender value before charges and MBA are applied, okay? And this will become a little more clear on the next slide when we add in interest credits. So as we mentioned, your account value starts at the premium. Now we start to get index credits added to your premium over time. And you'll see now my vested enhanced value, which is my walkaway value on surrender before charges, this is my lump sum death benefit, is starting to track with this account value, right? Why? Because now my index credits, let's say year 2, for example, I've got 14,940 exceeds my guaranteed credits of 8,000. So therefore, my vested value, my walkaway value is driven by my premium plus index credits, okay? If I didn't have any index credits, like the prior page, then the vested value would equal my premium plus my guaranteed credits, right? This value. So you should think about the account value and your vested guarantee as two separate pillars in the product. They don't interact with each other than if you die, you get the greater of the two. And if you surrender, you get the greater of the two. Okay? They're two separate values otherwise. And I just want to point this out because some people will ask. Now, once your index credits exceed 40% of your initial premium, so that happens in year 5 in this example, now my 5-year death benefit is equal to my lump sum death benefit. So at that point, we would expect most beneficiaries obviously just to take the lump sum once it exceeds, okay? And once that happens, that will always be the case moving forward. Once you exceed the guarantee, it'll always track equal to your account value moving forward. So we know there's some new terms here, but the reality is that you've got a product where you add index credits to premium, okay? So it works kind of like a non-bonus product to start with, but you've got this separate bucket, which is the premium growing at 4% simple interest as a backstop guarantee for you if you die, if you surrender. It's always there. I know a lot of folks also wonder about how withdrawals work. And so we wanted to show you an example where a client takes out the maximum free partial every single year that they can and what's left over. So in this product, the free partials work a little bit differently. We defined it to be 7% of initial premium starting in year 2. Why did we use initial premium instead of account value? We wanted the client to have a predictable stream of withdrawals over time. So if I define something as a percentage of account value, if I take out 7,000 this year and I don't have any index credits, well, next year I may only be able to take out 6,800. And then that may continue to decrease over time, because the account value can go down as you take withdrawals. Whereas if it's a percentage of premium, you know you have that free withdrawal amount every single year and it's locked in, okay? And so in this example, you can see that the client takes out $7,000 each year in years 2 through 10, so that's $63,000 in total. On a guaranteed basis, they're left with roughly $66,000, we'll call it, okay? So even when you take the maximum free partial out each year, you'll receive on a guaranteed basis over 10 years, $129,000 roughly. And there's no premium bonus product coming anywhere close to that. Okay. So accounts, we have 5 accounts on the product. We have a fixed rate, 450, very healthy fixed rate. It's competitive with non-bonus products in the market. 8% S&P cap. And remember, EquiTrust isn't playing the subsidy game. You may see caps out there, 10%, 11% plus, but it may be here today, gone tomorrow. This is a cap you can count on. Okay, 50% S&P par rate. I would encourage you guys to go look at non-bonus products. The market rate for non-bonus products on average is actually below 50. So 50 is near the top of the market for non-bonus. There are a couple products. EquiTrust has one of those products where you can get a bit higher than 50% on their non-bonus product, but there's very few. So this is keeping up with the top par rates in the market now with a 40% guarantee added on top of it. We have a 6.5% trigger. On the next page, I'll talk a little bit about why we prefer par and cap over trigger for this product, but that is an option for you. And we have a 70% S&P dynamic par rate. So let's do that. On this page, we're going to show you how each of these accounts performed over the last 10-year period ending December 31st, 2025. The first column is our guarantee, right? So no matter what happens, you're always guaranteed 140 at the end of 10 years. The 450 fixed interest would have got you to 155. So there's not much upside over the 140. So it's, unless you're really pessimistic about the market, this is meant to be indexed allocation on top of the guarantee. Our 1-year cap ended at 185. The 1-year par ended at 218. Just as a data point for you, and this is something Genesis, gives us some of our other presentations, a 1-year par beats a 1-year cap 80% of the time, roughly on average over a 10-year period. So if you allocated 100% to the cap for 10 years, or you allocated 100% to the par, on average, you would win 80% of the time with the par rate over the cap. And this product is really built for par rate because you've got this strong guarantee. So we think you should really swing for the fences with the par rate. I mean, that's my opinion. Obviously, decide whatever you would like to do. But it was built with that in mind.
I'll add a comment. What I use sometimes is why wear a belt and suspenders, right?
Right.
You've already got one of the strongest guaranteed FIAs out there. Why would you use the fixed, right? Like you said, swing for the fence with some of the other crediting options and have the peace of mind with that strong minimum.
Yeah, that's right. And that's the reason that, we look at the trigger, we ended at 165. There's not enough upside for me personally there over the 140. So that's why we tend to lean into the cap and the par rates. Our S&P Dynamic Index had a great run over the last 10 years. It was up to 269. We get asked often, does that mean I should choose S&P Dynamic over S&P 500? Right? The answer is no. That's not a reason to choose S&P Dynamic over S&P 500. These two options, S&P Par and S&P Dynamic Par, on average, should actually mirror each other pretty well over a 10-year period on average. There'll be some cases where S&P 500 is better, some cases where S&P Dynamic is better. They're meant to mirror each other. It just so happens over the last 10 years that S&P Dynamic has outperformed. I prefer, pure S&P 500 just because I know that's what clients see every day in the market. That's what they understand. It's a little easier to explain. But this is a great option for you if you don't want to have that conversation about renewal rates potentially moving around a little bit because it locks in that volatility. Roth conversions. So we mentioned earlier that we think this is the most competitive, Roth conversion solution out in the market, the most authentic solution. And one of the reasons, and Jeff, you could jump in here, please, is what EquiTrust provides on any product is really a turnkey, flexible Roth conversion solution. There's no limit on the conversion amount being equal to the penalty free. You can convert however much you want. The client can decide how much and when to convert. And EquiTrust makes it really easy. There's a lot of carriers out there where if you do a Roth conversion, let's say you do 5 partial conversions over the course of 5 years. Well, in that case, they're going to create a new contract for you every time. You may end up with 6 contracts if you do 5 partial tax conversions. That can be pretty complicated. Well, EquiTrust does it differently. They have 1 mere contract. So you're only going to have a non-Roth and a Roth bucket. And that's a lot easier to explain for folks. And the other cool part of that, Jeff, right, is you can decide how much of your withdrawal you want to take from each bucket. I want Roth money. I want non-Roth money.
Yeah, we've really hit a home run, and this also makes the phones ring over here at EquiTrust. We call it PTC, partial tax conversion. It's good for partial Roth conversions. It's also good for inherited IRAs, for ineligible beneficiaries that have 10 years to get the taxes paid. And from what I understand, it's the most flexible one out there. I mean, we're not the only ones that have a program, but to give that client the ability to make changes to it, really it helps. It helps if they have a year where they think they're going to bump into another tax bracket, they can let us know, don't convert this year, or let's change the amount. So extremely flexible.
Yeah, it's great. I mean, we hear nothing but praises about it from all the IMOs we work with, advisors. We know a lot of different carriers are jealous of the program you guys have. So why would you use a boost versus a bonus for a Roth conversion? There's some really, really cool advantages. I already hit on one, which I imagine most of your guys' clients, right, that are doing Roth conversions, they're worried about, the tax rates rising in the future. They're probably in tax brackets, let's say 22 to 37%. These are going to be most of our clients. Now, if I only have a 10 to 15% bonus, I'm only covering a small portion of my clients, right? Up to 100,000 of income roughly. Don't fool yourself. If you have a premium bonus of 20% or 25, it doesn't matter, and it's got a 95 basis point fee, you're also only covering 10 to 12% because they're taking that money back in a fee over time. Okay, we're not huge fans of paying a fee for a bonus for that reason. You end up worse on guarantee and worse on accumulation potential the vast majority of the time. So really, this is where the whole market is now for a premium bonus. And with SmartBoost, we're able to open it up to any client because we've got that 40% boost. The other really cool advantage, this is so important to understand, is that if you have a Roth conversion case, your client puts in $100,000 into, let's say, another premium bonus product. And let's say they get a $20,000 premium bonus. If you convert after that point, your client, let's say you converted it all immediately after, your client will pay taxes on the premium and the premium bonus of $120,000, regardless of whether that bonus is vested or not. Whereas with SmartBoost, because our account value starts at premium, not premium plus boost, okay, you would only pay tax on the premium itself, so $100,000, and then you would pay tax on the boost as it vests, $4,000 a year, okay, depending on when you convert. If you converted it immediately, you wouldn't pay it on the boost. If you converted after a year, you'd pay it on 104 and then 108, et cetera. So not only are we covering more tax, offsetting more tax, we're also lowering the taxable amount, okay, the tax basis. So that's really 2 cool advantages of the product. And when you combine that with EquiTrust's simple program of this mere contract, there's really nothing like it out in the market from a Roth conversion perspective. And so with that, I'm going to turn it back to Jeff, and we'll finish up with a summary here, and then he's going to take you through some really cool comp incentives that are, I think a lot of the folks on the call will be interested in hearing.
Thanks, Chad. Yeah, so just kind of to recap, SmartBoost is providing a very solid minimum guarantee with some really good upside potential, right? And it is also the death benefit. The legacy play is very strong. And again, I'll reiterate, there's no fee. There's no fee for this, for these features. It's great for somebody who's experienced some market loss, or like Chad said, that it's a no excuses type of FIA. And then we've already kind of talked about the Roth conversion and the role that it plays in that program. I will say one of the things that we noticed when SmartBoost got launched, we seemed to be we were attracting new agents to EquiTrust. So we saw a lot of agents who had never been appointed with us get appointed after we launched this product. And then we've also kind of seen a higher average case size with SmartBoost as well. So a couple of really neat things, byproducts of getting the product out there.
Hey, Jeff, can you talk about the suitability quick on the like exchange business?
Yeah. So from a suitability standpoint, we can entertain surrender charges up to, I think it's around 15%, because the boost is so strong. Now, obviously, on any kind of replacement, we got to make sure at the end of the day that we're putting the client in a better position. And we're always happy to walk through any cases that you might be working on. You may have some questions about suitability. We have a pre-suitability form if we need to go there. But we are willing to, with this design, to take on a little heftier of a surrender charge on a replacement.
Okay. Yeah, that's great. I mean, so I just want to point that out because this can be used for exchanges just like premium bonus product can, and it's as competitive as any of those.
Yeah, great point. Do you want to go to the next? Yeah, okay. So just kind of give you the high level specs, right? It is single premium. We do need at least 10,000 to open it. We can write it up to including age 80. Chad went over the penalty free withdrawals, very different from our other products that are normally 10% on the accumulation value. It's got the nursing home waiver, the terminal illness waiver, strong commission. We've been running a commission special on this, and that is set to go through the month of June. And then, we've already kind of covered the product benefits and how the boost works. Yeah, so just a good overview of the product specs. We'll never have it in New York. EquiTrust just doesn't do business in New York, but we are still waiting on California. Otherwise, the rest of the states, it's approved either, the full version or maybe a slight variation as well. And then I've already kind of talked about the commission special. We got it on there twice. Make sure that you know about that. And that is through June, and that is based on application receive date. And then we also, we've added another tier to our agent compensation program. So when you hit 5 million, we go back to the first dollar of the year, and we pay another 1%. If somebody hits 10 million, then we'll add another 50 basis points to that. And if they hit 15 million, it's actually 2 points going back to the first dollar of the beginning of the year.
Right. So, I mean, Jeff, I'll just interject here that EquiTrust program, I think it's one of the most competitive out in the market in terms of a tier compensation just to start with. Now you've got this extra 1% commission you can take advantage of through, at least June 30th. And so this product, has top tier compensation along with all the client benefits that we talked about.
Yeah, thanks. And then just make sure you guys know we just announced our incentive trip, and the qualification period. It started at April the 1st. It goes through March 31st of next year. And you do need at least 5 million to be in the running, but what we'll do is we'll take the top 50 financial professionals to Napa Valley, and usually, when we do our trips, we don't hold back. They're always to the nines. So just wanted to make sure you saw some of the incentives that we have out there.
Sounds great.
All right. So we're going to turn it back over to Paja and see if there's any questions or.
Yeah, of course. That was a lot of great information from the two of you guys. Let's see here. So a couple of questions that we had is just what type of clients are the best for this? It seems like there's a lot of great benefits and it looks like it can fit a lot of different clients, but do you guys have a basis of what that would be?
Yeah, I think there's a couple of clients. Like one, this would be a good product for transitioning a client who's normally buying MIGAs, multi-year guaranteed annuities. They like the safety of those. This is a great product to transition somebody from a MIGA to the FIA space through SmartBoost. Again, that no apologies FIA. So that's a good one. Somebody that wants they like the upside potential with a very, very strong guarantee. I think those folks are going to be very attracted to the product. Roth conversion clients also, I think, are going to be very attracted to the product as well.
Yeah, and I'll just add on to that. I mean, so what we've heard from different advisors and firms, really any accumulation focused sale that you would put a client into the FIA, I mean, this fits the bill because when you look at it and you say, hey, I really like non-bonus products because I don't want to give up accumulation, crediting rates. Well, now you've got a very, very competitive product with non-bonus accumulation on top of a 40% guarantee. So you got to ask yourself, am I okay giving up maybe 5% of par rate, maybe 1% of cap in order to get a 40% guarantee so that I never have that zero conversation? And for most advisors, what we've heard is absolutely, that's worth it. And so advisors starting with that guarantee story to sell it, and then they're upselling, if you will, with the accumulation side. So we believe it fits really any accumulation story that you put a client into an FIA. And as Jeff mentioned, that MIGA alternative, right? Now you've got something that offers really strong guarantees like a MIGA, but with FIA upside for that client. And by the way, FIA comp for the advisor too, which is the biggest complaint I think a lot of advisors have about MIGAs.
Yes.
Yeah, that's a lot of great reasons. Different kinds of clients too.
Yeah.
So I'm not sure if both of you had, maybe more Jeff than you, Chad, but are there any reasons or things that you've run into as to why agents are hesitating on adopting this product?
I would say so. Over at EquiTrust, we've always kind of touted ourselves as being a simple company, simple products, simple procedures. SmartBoost, I would say, has a little more to it, but don't be afraid of it, right? I mean, once you and Chad did a great job of walking through some of those illustrations and the different values. So I don't want to call it a complicated product because it's not. But compared to our other products, there's a little more to it.
Yeah. I think it's just from a client perspective. I mean, there's some new terms. There's always new stuff. We go through this every time we launch a new product, Jeff.
Yeah, right.
It's don't overcomplicate it. It's a FIA at its core with a 50% par rate, 8% cap, and a 40% guarantee. Right, if you live, it's got a 40% guarantee if you die. That's all that is, and all the other stuff is just terminology. And the other reason I'll throw it out there, Jeff, that we've heard some advisors, kind of groan a little bit about the 7% of free partial versus 10. The reality is, Jeff, and this, 90 to 95% of clients are taking less than 5%. So there's very few clients who are taking 10%. If your client is taking out 10% every year from their annuity, they should not probably be an annuity. That's not the product if your client needs that much liquidity every single year to be in. And so the reality is that what 7% gives us is much more juice in the guarantee and in the accumulation, and that's where we put it. Because for 95% of clients, that's going to be way more beneficial than having that 10% liquidity, which, by the way, that 10% liquidity can become 7 or 8% of your initial premium if you don't have any credits, right? So.
Yeah, that sounds great. It makes total sense. Alrighty, it looks like we are running short on time here. So, Chad and Jeff, thank you both again for taking the time to walk us through the SmartBoost Index today. And for everyone who joined us today, thank you for spending part of your day with us. We hope today's session gives you practical ideas and greater confidence in discussing this product, especially. So, if you have any follow up questions other than what we've discussed today, and you'd like some additional product information, you're always welcome to reach out to the NFI team. And thank you again to Jeff and Chad, and we'll see you guys in the next webinar.
Thank
Thank
you.
you.